We're going to start the record. Lovely. Hit the record button. So I'm delighted to introduce to you Soraya and Mr. Deji. So Soraya Johnson is a financial educator. She empowers others to understand how money works. She's passionate so that people will understand financial matters and able to make smart decisions to expect their desires results. And also, I'm excited to also introduce you to Mr. Deji. Mr. Deji is a financial advisor, a practice principal specializing in investment, pension, savings, and mortgages. So without further ado, I am going to open the floor and invite Soraya to share with us. So we'll just give you a warm welcome. I know we're online, it's virtual, but open the floor up to you, Soraya. Can we all put ourselves on mute? Sorry, because there's a bit of noise in the background. So if I think that would help us if we did that. Okay. Soraya, are you fine?
I am. Can you make me co-host, please?
Oh, I see. Okay, lovely. Yeah, I've got IT person here to help.
Right. Where are you? Soraya. Okay.
Yeah. Co-host. Brilliant.
Great. Good evening, everyone. Good afternoon, good evening, whatever the day is for you. Welcome and thank you for having me, Annie. Welcome, Deji, and thank you also. Yeah, there's a bit of echoing here.
Yeah.
Is everyone on mute? Can everyone mute themselves?
I'll mute myself as well. I'm just the only one left, so I'll put myself in mute. Where am I? Yes.
That would be great. Thank you. So I'm just going to go straight into my presentation and hopefully you'll pick up with it. I'm somebody that's very simple, but I will introduce myself. I mean, Annie's already introduced me as Soraya Johnson, so I will take you along my journey. Let me just share with you. So can everyone see my screen? Annie, can you see my screen? Yeah, great, fantastic. So I know this is obviously a women's event, so this is just to replicate this first page. I'm Soraya Johnson, I'm a financial educator, and you know, financial education is for all ages. Sometimes we think it's, oh, when you start working, sometimes we think, oh, it's when you get to retirement. Sometimes we think, oh, well, it's, you know, as you're about to get married, and we have all these concepts in our mind. But financial education is for everyone, whether you're a child, whether you're, you know, in your early adult years, late adult years, it's for everyone, okay? So my story, I'll just give you a little bit about myself. As I said, my name is Soraya Johnson. I'm a financial educator. I've been in this industry now for 5 years. And the reason why I joined this was because you know, when this was introduced to me, that year it was introduced to me, I lost 2 girlfriends to cancer. One was one Tuesday, and my friend was financially, you know, astute. She had property, she was, you know, she was single. She was basically okay. So when I say she passed away, everything went smoothly. The following Tuesday, I lost another girlfriend to cancer, and she left behind a husband and a 5-year-old son. Now, you know, you're saying to me, well, Soraya, I don't understand this. Financial education hits us wherever we are in life. When my friend died and left her husband and her 5-year-old son behind, her husband was the main carer for her and the son. So she died on the Tuesday. He put the house on the market on the Wednesday and accepted the offer for that house on the Friday. I couldn't understand why he was doing that. You know, I'm somebody that has property investment, and it was like, that's the most craziest thing you ever do. Why would you do that? He was like, Soraya, I have to. Fast forward in a few days, And basically, you know, he kind of upped and went. Myself and a few friends were left to pack up all of his things. And financial education was introduced to me, and I was like, wow, if he'd only known this. And I'm not saying that if he'd only known that at the time or when he sold his property. I'm talking about if they'd known this as a couple well before the wife was diagnosed with cancer. So I got involved in this, and, you know, as I said, he accepted the offer for property, sold the house and took off to the sunny island of Jamaica. He came back a year later, and myself and another friend of mine who is also a financial educator, a business partner of mine, we showed him the concept of what we did. And he was like, wow, if I'd known this before, I would have had a choice. And the reason why he says he would have had a choice is because he felt he had to sell the property. If he'd been educated, as some of us, many of us have not been educated, he said, I would have had a choice whether to keep the property and still go to Jamaica. He might have still gone to Jamaica and sold the property, but he would have had a choice. At the time of grieving, he felt he didn't have to have a choice, and he had to work quickly. Why did he have to work quickly? Because he was the main carer. So the Tuesday she passed, the Wednesday, the benefits that they were receiving stopped. Okay, so he would have had 4 weeks literally to find a job, to catch up on the arrears and the mortgage, to find a carer for his son, you know, and put everything in order, as well as dealing with the grief. Now, yeah, that may seem like an extreme case, but, you know, there's many, and every single week, you know, we're hearing of similar situations in families. You know, COVID has happened. You know, what do I do? How's it hitting my family? Being furloughed. We just don't know what's around the corner. Yes, we're women of God, Deji, man of God. We're men and women of God. You know, so we have our trust in Christ. We have our trust in the word. However, the Bible says that we must write the vision and make it plain. We must plan. You know, it's not a case of just getting up and saying, yep, we're into today. Whatever comes our way, Lord, you're going to catch it. He delegated all authority over to us, and we have to be wise with that information. A little bit about myself. As I said, I've been in property as well. And that's pretty much what I do. I educate families on how to become debt-free and financially independent. And I also build a property investment portfolio. So I'd like to start with, what is your dream? How are you going to get there? How are you going to achieve it? And as you can see here, here's a picture of a house. Okay, and I want you to think of this as your financial house. This is your financial house. And look at the foundation on the first floor as a clear, just clear. Just look at it as clear. When you're starting with the foundation, it has to be clear. The grounds have to be clear. You have to start from the ground up. Then it has to be concise. Let's move to the second floor. It has to be concise. You're now building, things have to be concise. They have to be in order. We move to the third floor, and it's mental. Now you're starting to think about the mental picture, okay, that's been put into place to build this financial house. Now the picture is the roof. I've got that as a roof because you can now see the full picture of your financial house. Now Napoleon Hill has got he's written a book called, the original title was How to Raise Your Salary. Now it's been rewritten, and it's an interview by Andrew Carnegie as told by Napoleon Hill. And it says in there, all riches and all material things that anyone acquires through effort begin in the form of a concise, clear, concise mental picture of the thing one seeks. Okay, so that's the CCMP. So what does a clear, concise mental picture mean? So I want you to think about what you want. Where do you want to be? And what do you want to do in 1, 3, 5, 10, and 20 years' time? Remember that each goal must have a completion date. Don't make it outrageously large. It has to be something that is achievable and stretchingly realistic. Now you're thinking, well, Soraya, what's this got to do with finances? Your finances have to be clear, they have to be concise, and yes, they have to be a mental picture. Now, discussing finances, I'm sure Deji will come on to that, is not the most exciting topic. So I have tried to make this a little bit exciting, but there is a lot of wording to my presentation. So this will be your CCMP, clear, concise mental picture. After you've decided upon your CCMP and the target date, you need a daily, weekly, and monthly plan to guide you there. Prepare for your financial journey. Yep, it's a financial journey. You're getting on that plane. Where are you heading? Well, when traveling, you first decide on a destination. Then you plan a route that will take you there. In much the same way, when embarking on your financial journey, you need to decide where you want to end up. Then chart a course that will lead you to your goal. For many of us, setting goals wasn't something we were taught in school. However, it is vitally important to our success in life. Trying to achieve financial independence without setting goals is like trying to find your destination without knowing the address. It's almost impossible. And something I always like to say is, you know, when you're a toddler, from baby, you're taught how to crawl. You know, you kind of crawl, you kind of learn your way, you know, you've got your parents going, come on, come on. Then you go from crawling to walking. You're encouraged, you know, take that first step. Someone's holding your hand, take that first step. Then from being a toddler, you go to nursery, you're being prepared for that, you know, to talk, to read, you're having books read to you. From nursery to primary school to secondary school, college to university, and then the JOB, the work. And then what? You're left. Nobody guides you, nobody leads you, nobody shows you where to go, nobody shows you what to do. You're just left. And you're left with the thought that because you're an adult, you know exactly what to do with those finances, but nobody's educated you. No one. And the only one that keeps pouring into you and telling you which direction to go is usually the job, your employer, who usually send you on courses or encourage you to go on courses to impact and empower you to be better for them, not for you and your family. Here are some examples that you may be thinking of. A short-term goal, 1 to 12 months. Take a weekend trip, maybe in 3 months' time. Pay off the credit cards in 12 months' time. Have £3,000 in an emergency fund 6 months from now. Now, some of you may already have that. Some of you may already be traveling. Some of you may already have 10, 20, 30,000 in savings. But I'm practical, and I would like to just keep this very basic. There are many people that do not. They don't have this, and they would just like to know, how do I get on the track? How do I clear those credit cards? How do I clear my mortgage? How do I create an emergency fund? Then you might have a medium term of 1 to 5 years, go on that long haul holiday, purchase a car without finance, without having to take out HP, having 20,000 deposit for a new home in 4 years' time. And you're thinking, is that realistic? Yeah, it can be achieved. We help families every single day in achieving that. And long term, 5 years or more, retire in 10 years' time with £2,000 a month income, have £30,000 as a legacy fund, or purchase a holiday home here or abroad. Let's take a look at how to do this with a third goal from the short-term category. Have £3,000 in an emergency fund 6 months from now. The amount needed is £3,000. Months available to target 6 months. The amount to save each month, £500. 3,000 divided by 6 months. The amount to save each week, oops, that's kind of gone ski whiff there, is £125, which is 500 divided by 4 weeks in each month. So with this information, you will know exactly how much you need to save each week in order to have £3,000 in 6 months. It's simple. If you reach your small goal of saving £125 each week, when your 6-month target date rolls around, you'll have the £3,000. So now you're saying to me, okay, that's great, Soraya. You might be robbing Peter to pay Paul. You might be thinking, well, where does that extra £125 come from? Finding money to save. Yep. So as I said, you might be thinking that our example of £125 a week sounds great, but you have no idea where to find that money. By creating a budget and taking a careful look at your financial situation alongside your goals, you'll be surprised at the money that you can save. Look at each expense and ask yourself if you would be willing to give it up in order to achieve your goal. Our fact finder. So again, I sit with families day in and day out, helping them with their fact finder, is a comprehensive tool designed to help you plan a sensible budget. On average, people save £100 to £300 a month by using this tool. Okay, and yet on the side here, we've got cappuccino. Some of you, not so much now because most people are working from home. Maybe you're even retired. But that coffee that you used to buy every single day, for some of you that are now furloughed and working from home, you're saving on travel expenses, you're saving on lunch expenses, you're saving on that coffee. So as you can see at the bottom, it says example, a £3 coffee doesn't sound like much. But if you have one every day, you'll spend more than £1,000 a year on these coffees. And that's just one example. So many examples that we can pull out. Okay, so here are some money making tips. Sell unwanted items on eBay. Now I'm seeing that there's so many different apps being promoted on TV. There's so many different that don't even charge you, where you can, that item of clothing that's been in your wardrobe for 3 years that you've never worn, and you're like, yeah, that's the item that I wear when I go to a wedding. The next wedding that comes up, you're like, yeah. Or someone says to you, your daughter, or maybe a friend says to you, it's not really the way forward now. It's not really the thing. Sell it on eBay. Even if you get £2 for it, even if you get £3 for it, just think about that coffee. £3 per item, £3 a day. What can that amount to? Work a part-time job. You're saying, well, so what's that? Yeah, obviously the supermarkets went crazy last year in recruiting. You've got, lots of delivery jobs now. I know on my road, every day I'm seeing a car pull up delivering, goods and packages. Start your own business. It's never too late to start your own business. As women of God, you're encouraged, to be virtuous women. Be that Proverbs 31 woman, virtuous, putting your hand to the grind. Or business opportunities, something that's already existing, and you think, okay, you know what? Maybe I can put my hands to this and work it as a part-time, spare time type opportunity. Rent out a room if you have a spare one. Why not? If you live in London, not even in London. The other day I took on a property in Manchester. I was shocked. The rent for a 2-bed flat in Manchester was £875. £875. So no matter where you are, you can get additional income for a spare room. So I want to talk to you about debt stacking. Okay. You're saying to me, so what's debt stacking? You can see this picture here. It says 1 down, 2 to go.
Thank you.
Slowly getting rid of that.
They can't see me though, can I? Yeah.
Slowly getting rid of those debts. So debt stacking is when you succeed in paying off a debt, avoid the temptation to spend that freed up monthly amount and use debt stacking instead. Because what do most people do with freed up money? I've paid off that credit card. Oh, now I've got an extra £100. No, you haven't got an extra £100. You've still got loans. You've still got a mortgage. You've still got outstanding stuff. Or you need to start saving for your retirement or that investment or that legacy fund. So don't look at it as freed up monthly income. Simply make normal monthly payments to all your creditors. When one debt is paid in full, apply the amount you were previously paying to the next debt you have targeted to pay off. So here's an example, okay? Without debt stacking, it may take you 23 years to pay off your debt. You can see this example here. The interest saved is 0 because you're giving all this money to the banks and building societies. The interest paid, 214,000, monthly payments, 2,720. With debt stacking, you pay that off in 9 years' time, saving yourself 130,000. So that's 130,000 in your pocket, not in the bank's pocket. Interest paid, 83,799. So the monthly payments are 2,720. So the monthly payments, this example is taking into consideration credit cards, personal loan, and a mortgage. Okay, so your monthly outgoings are about 2,720. So here's an example of how you would stack those debts. So you can see here, retail card, a credit card. For those of you that have just come on, we welcome you, but can you just mute yourself? So retail card, credit card, car loan, another credit card. So you can see the payments on the left-hand side, £220 to a retail card, £353 to a credit card, £551 to a car loan, £303 to another credit card, and the mortgage £1,293, totaling to £2,720. So you attack the first retail credit card. And I say attack it because you have to look at it as an enemy. You need to attack that and pay it off. The moment that's paid off, you take that £220 and you put it onto the next credit card that you were paying £353 a month to. So you're now paying £573 a month to the next credit card. Okay. You now take that and you add all of that to the car loan. So you were paying £550 a month to the car loan, but now you're taking the £353 that you were paying to the second credit card and a retail card of £220, and you're adding that onto the car loan. So you now pay off that car loan by paying £1,124 a month. Now you attack the last credit card, which you were paying £303 a month to, and you add that £1,124 and you attack that last credit card with £1,427. Once you've paid off that last credit card, you now take that and you add it onto your mortgage. Now you're saying, yeah, but so why? I know some of you are saying, will the mortgage company allow me to do that? You know, is there a clause? Now, you know, there are different mortgages, and this isn't a blanket response. This is just a principle that I'm sharing with you. So some mortgages allow you to pay an extra 10% more, but there's other strategies, bi-weekly payments, you know, splitting that down into weekly, bi-weekly, adding on an extra £50 a week. All of these principles, we can sit down and share that with you to help you to shave off that mortgage and pay it off a lot quicker. So now I'd like to share with you the 70-10-10-10 rule. Okay, so we've dealt with the debt stacking. I hope you've made your notes and you're kind of like, you might think, well, Sway, that was a lot of information. Don't worry about it. You know, I know after Deji speaks, we'll have question and answer time. So the 70-10-10 rule, it's an easy formula to remember because it's 10-10-10-70 principle. So start by allocating 10% of your monthly income to each of the following categories: emergency fund, long-term savings, and giving, and the remaining 70% is for your living expenses. This is what you'll use to pay your bills, buy your groceries, your fuel, you know, petrol, etc. So this is pretty much what it looks like. Now we've got giving in there, 10%. For a lot of us as Christians, we know that as tithing. If you're not a Christian, welcome. You know, to be successful and to get your money working harder for you, there's a principle in giving. You will always receive. So whether you're a Christian or not, get into the habit of giving. Give to your local charity. You know, it will always come back to you 100-fold. So there you go, 10%, God first, tithe. Another 10% is investment. There's a way to even beat the tax man with this. And I'm sure Deji will explain that afterwards. Then investing in yourself, that's personal development, that's your family, that's your friends, that's going out for meals, you know, just that kind of play stroke investment pot. And then 70% to your bills, your debt repayment, and other living expenses. Now, some of you are thinking, so why there's no slack in my money? Okay. Now, I don't know if you've ever heard of a gentleman called T. Harv Eker. He's a motivational speaker in finance and millionaire mind concept. He's explained, I mean, I've been on some of his courses over the years. Even if it takes a penny, start with a penny. If that's all you have left, get some jars. Get 4 jars. 10% for your tithing, 10% for your investment, 10% for your personal development, your family and friends. And start to put in those jars, you know, that penny, that 10 pence, whatever it is, just start the principles and teach this to your children, teach it to your children and your children's children. A lot of us, when we take out a mortgage, a mortgage broker, financial advisor, they see what your affordability is. When I learned this principle many years ago, I was like, wow, why not this? Really what we should be saying is 50% of my salary should be going to pay, for example, towards my mortgage or your rent, 20% towards your other living expenses, and then 10, 10, 10. That way you'll always live within your budget. You'll always be able to save. But many of us, it's kind of that go to the limit. So, you're earning 1,500 and your mortgage is 900 and you're like, anything goes wrong, it's always, and yes, the mortgage companies and the financial advisors and brokers, they do means test it, but just have the principle of 70% should be your expenses and you should have 30% left over each month. So how compounding works? Just want you to understand compounding. So if you were offered £1,000 per day, now I want a little bit of engagement here, so you can kind of put your thumbs up or, if you were offered £1,000 per day for 30 days, or a penny on a day one with your money doubling every day for 30 days, and Deji, you're not allowed to take part, which would you choose? So put your hands up for those that would take £1,000 every day for 30 days. Do a thumbs up. No? So, okay, a few of you. What about a penny on day one with your money doubling every day for 30 days? Okay. So, some of you are very, very smart ladies, virtuous women. So, £1,000 for 30 days, as we all know, is £30,000. Now, a penny every day, 30 days, is over multi-millions. Can't even say those figures. Multi-millions. Now, you're saying, well, what's that got to do with anything? You're just talking about debt stacking and just talking about 70-70. You know why? Because we need to understand how to get our money working as hard for us as we work for our money. So in that 10-10-10 principle, you need to be thinking, okay, my investment, how is that working hard for me? Okay, so if your money is doubling, and I haven't gone in, I'm not going into it in this session with you today, but look up the rule of 72. Get your money working hard for you. The rule of 72 is an old banking principle, which basically is how banks have always calculated how to make money. Okay, way before calculators and computers came in. And they make money off of your savings. Now, what we do is we educate families how to get that same principle working for you. Now, yeah, okay, you're saying, well, how are you going to get that penny doubling for me every single day? Okay, maybe it's an extreme. But even if you got half of that or a third of that, I can probably put my hand on heart and say you'd still be satisfied with it. So just understand how compounding works, because the banks have it working for them. We need you to get this principle working for you and your family. So 30,000 over for 30 days versus millions, which would you choose now? So for those of you that chose the 30,000, now you can see compounding, penny doubling every day is worth a lot more. 67-year-olds. I'm going to deal with 67-year-olds, and this doesn't mean if you're not 67, it doesn't apply to you. It doesn't mean if you are 67, this doesn't apply to you. So this is a statistic. It says currently, But these statistics haven't changed for hundreds of years. Napoleon Hill wrote about the same statistics, and they're the same today, okay? So currently, out of every 100 workers reaching the age of 67, only 1 is wealthy. 4 are financially independent, 41 are still working, and 54 are dead broke. Which group made a plan and stuck to it? I should say, which groups? Probably 1 and 4. Now, many of you, usually when I sit with families, I say, which category would you like to fall into? And which category would you like to be in? And nobody says, I'd still like to be working at 67, or I'd like to be dead broke at 67. No way. It's usually 1 or 4. Now, 1% in the wealthy bracket means that your assets or your net worth is 2.5 million plus upwards, okay? The 4% financially independent, it means that your net worth is anywhere between 500,000 and 2.4 million. You're saying to me, well, so what's net worth? Net worth is what you are worth, your total worth. So if you were to sell everything, your assets minus your liabilities, what you're left with is your net worth. When you look at celebrities, you Google anyone now, you put their name into Google, it comes up usually on the right-hand side, it tells you net worth 2 million, net worth 3 billion, net worth 240 million. So the wealthy never look at working income, annual income, how much they're getting on a weekly basis, how much they're earning, what their pay rise is going to be. The wealthy are always thinking about net worth. So I'm sharing with you, for those of you that are saying, yep, I'm going for that wealthy bracket, you have to be thinking about building your net worth. So that's your assets. The 4% financially independent are still working towards the same, but they're working more at a steady pace. So, you know, maybe you've bought a property, maybe you've bought a couple of properties, minus the liabilities, probably still valuing up 500,000. When you get to retirement, you've still got an income coming in. Now, you think, well, so why, maybe you're already 67, how can you work that? It's still possible. For those of you that are thinking, you know, talk, you know, there's so much out there that can help you to get there. Basic principles. No, I'm not saying it's easy. I'm not saying, you know, click your finger and it's going to be like that. I'm not saying just, you know, fast for 5 days and, you know, everything's just going to come pouring in. No, it will take a little bit of work, but it will be worth it. So how do we need to look at this diagram here? How am I doing for time? Okay. How life really works. If you look at this blue line here in the diagram, I want you to look at that as term life insurance. But I want you to look at this green line here as investment. Now, what we educate is that in early years of life, you may need a lot of coverage, okay? Because you've got young children, maybe high debt, house mortgage, loss of income would be devastating. But at later years, the children are growing up, the debt's lowered, the mortgage is paid off. And the most important thing that's needed at this stage is a retirement income. So what we educate is that you work both of these parallel here. You work both of them parallel with each other. So when you take out life insurance, which is something that we can also help you with, I know Deji's going to speak with you about that. When you look at life insurance, you're renting wealth, you're passing on that risk that may happen, okay, onto the life insurance company. Now, in your later years, you don't need that because you've set out a plan and you've built an investment pot. So at later years, you've got now a retirement pot, an investment pot, which will serve you to enjoy your retirement. Now, just as just to end on this, I'd like to just say that what we do with families, and as I said, I know Deji's going to come on and speak about this, is I believe that we're the only financial services company in the UK that show you how to work out how much life insurance you need. Because sometimes you take out life insurance here and it's just been sold to you. The banks or the building societies, you know, they've just sold you something that you think, okay, well, yeah, they're there for you. They're not. The banks and building societies have hurt people over the years, which is why they've been fined millions of pounds, because they've hurt a lot of consumers. So what we do is we sit down and we show you how much you will need to take out in order to cover and be realistic and holistic for you and your family for today and in the future. So that's the end of my presentation. This is my details, Sawyer Johnson, that's my telephone number there. Kind of quickly just added that in just as we started, because I did promise Annie that I would put my details there. So please take a screenshot. I know you're going to get a recording probably from Annie, but you know, by all means, take my number. So I hope you got something out of that. I know it was rushed. I know it was a lot of information, but we will have questions and answers at the end. So Annie,
yes, thank you, Soraya.
Back to you.
Thank you very much. In fact, thank you so much for that. So much information there. And I think it would be great, actually, if we gave opportunity for people to just be able to respond to that. So at this stage, I think we would be happy to do maybe 1 or 2 questions. We can have more questions at the end, but I also appreciate sometimes being online for a long time and listening to information. So if anyone has questions at this point in response to the information which Soraya has provided us with, I'm feeling empowered. Please do ask questions. You can drop something in the chat, or you can unmute yourself and ask a question. So whichever one you prefer. So I'll just we'll sort of take about 10 minutes so that it's sort of a good way to also break for us. So any questions, comments?
Yeah, I have a question, Annie. This is Shireen. Hi, Soraya. That was an amazing presentation. I just, you know, sometimes at the weekend you think, oh, what am I going to do? My weekend was worth spending just even hearing you speak for 40 minutes. So bless you tremendously. And I will be reaching out to you privately as well for some advice. But when you're looking at the information you've given us, if you are limited in your income, would you say that which would come first, the debt stacking or the saving? Now, I know you've given us that principle of the 10-10-10, but if you had to make a choice, which one do you go for first?
You've given me one or the other, and I would say both. But if you say to me which one first, I would say the debt stacking.
Okay, that's fine. Thank you.
That's brilliant. Thank you. Thank you, Shireen. Any more questions or comments? Please feel free. Just open it to the floor. Okay.
So there was one thing. Do we get your presentation? Do we get a copy of that?
Annie's recorded it, so I'm sure you'll get the whole thing. Is that right, Annie?
Yes, absolutely. Yes, we are.
Okay, I was talking about the PowerPoint.
The PowerPoint. I will leave that to Soraya. I don't know whether that's proprietary or not, so I'll let you answer that.
If you do contact me privately, anyone, I do have an ebook that I can send you that a lot of that information is in there. So
fantastic. Thank you. Okay, well, I'll give you time to then reflect more and ask questions when you're ready. So
I have a question.
Oh, okay. Thank you. Please.
So my question is, Soraya, thank you very much for your presentation. You are advising on savings, but with the economy as it is now, where do you save that you are going to get a good interest?
Well, I'm sure that Deji is going to probably deal with that afterwards. In terms of savings, so just let me make it clear. There's a difference between savings and investment. So savings is literally going to be kind of in the bank where you can get access to it fairly quickly, or you have your ISAs. Investment is going to be for your long term. Now, savings, you know, as you say, right now, we're literally looking at probably about 0.5% in the banks. Yeah, it's not great. And that's why you don't want to keep too much money in your bank or building society, because it's not doing that or too great for you. So that's kind of your emergency pot. Then you need to have an ISA or an investment vehicle where you're going to get your money working a lot harder for you long term. Okay, but I'm sure Deji will. Let me just put a disclaimer out there. I'm not an advisor. I am a financial educator. So a lot of it is the principles.
Yes. Yeah, thank you. That's a really good question. And yes, just to support that really, this session is not about advice, because obviously you need to consider people's individual circumstances in order to give advice. It really, please consider it as being awareness, exposure, education, so that we have the ability to make smarter financial decisions that will result in the desired outcome that we all want. So thank you. I think we've got two people who have their hands raised. Edith and Lara, would you like to unmute yourself and ask the questions, or drop it in the, Lara, yes.
Okay, I wanted to ask the same question she asked about where can you invest, and you've already answered the question that this is more on, you know, on not where to put your money, but to make sure you have a good culture of saving and investing your money. So you've already answered the question, Annie, but it's quite good.
Brilliant, thank you. That's my sister from Nigeria. Thank you for joining us.
My sister from Nigeria.
I'm in the car. Wait. Sorry, a bit dark here. I'm in the car.
Great, thank you. And then I think we've got Edith, and that will be the last one I'll take, so that we can hand over to Mr. Deji. Edith?
Yeah, hi, Annie. Sorry, my hand was raised up from previously when, yeah, and I forgot to remove it, but I didn't have any question. Yeah. Thank you.
That's fine. That's fine. Thank you. Okay, well, without further ado, I will hand
Sorry, Annie, can I just, before you introduce Mr. Deji, can I just say to everyone, some people say to me, well, what's best? You know, is it stocks and shares or property investment? And I always say, you know what, you have to know what's good for you. Because for me, personally, I know Annie and I have had this conversation, stocks and shares, I'm like, looking at those graphs, I'm like, oh, you know, this year, I thought, okay, so, you know, get into it, kind of looked at it and I was like, you know what, these numbers. Now, some people don't like property. You give me a property and I'll deal with it. But then some people say to me, oh my God, so how do you cope? You know, I've had a builder that's left me with no roof, no sidewall, you know, the rain is just pouring in. Some people would just have a heartache about that. And they would just prefer to do stocks and shares. So it's a personal decision, and you have to know where your spirit, what moves you and what you think that you can manage and what you can cope with. Okay, so I just wanted to put that out there, because a lot of you have got, maybe you've got 10,000 and you could invest in a property up north, or you could put that into stocks and shares. And I'm sure, you know, that will be explored later. So just wanted to put that out there.
Oh, no, thank you. Thank you. That's welcome. So without further ado, Mr. Deji, thank you so much. You are brave for agreeing to talk to us amongst women, but we really appreciate that. Thank you. And I hand over to you. Mr. Deji, as I said, is a financial advisor. He specializes in insurance, investment, property, and pension. So over to you, Mr. Deji. Thank you.
Thank you, Annie. And thank you, Soraya. That was really excellent. The stuff that you went through, I picked up some points that I can use. Great. I'm a financial advisor. I've been a financial advisor now for well over 25 years. And my job is really and truly to work with people to achieve their financial objectives and goals and give them financial peace of mind. What I'd like to do is share the screen, and then I'll run through, give you an overview of what financial planning is all about. To share the screen, do you need to initiate that?
Okay, so I've made you co-host, which means
Okay, so I can go on. Oops. Wait a minute. So I should be able to do it. Host is disabled. Okay, screen. I don't know if it's allowing me to screen share.
Okay, I'll let Remy make co-host. We'll do that again. So we'll say yes.
So I should be able to do it now. Okay.
Brilliant.
Yeah. Okay.
Great.
So if I just okay, can everyone see that? Yeah. Okay. So what is the financial planning process? So I'll just run through what it is. Defining your goals. Soraya has alluded to this, or referred to this in her talk. Defining your goals, short-term, medium-term, long-term goals. Where do you want to be in the next couple of years? Where do you want to be in the next 5 to 7 years? And where do you want to be in the very later years of your life? Reviewing where you are now. One of the very important things with financial planning is getting the information of where you actually are now. How much do you have? What assets do you have? How much do you owe? What's your income? What are your outgoings? All that information becomes extremely important in order for us to begin a financial plan. With that information, we analyze it, and then develop a plan that you can use throughout your life. And then we implement that plan, put that plan in place. A plan is simply an idea until you actually put it in place. So the implementation of that plan is extremely important. And then regular reviews. If you're not having regular reviews, that plan could go off track. So what are the main areas to consider with financial planning? First, and probably the most important part of any financial plan is financial protection. If you don't protect what you're building up, your plan could fall apart if anything were to happen. Then retirement planning, looking at how you can put together enough money to stop working, or enough money to begin to pursue the things that you've always wanted to do in later life. Investing, what's happening to money you've got? If you've got money in a bank account and you're receiving 0.5%, you're not even getting a return that's better than inflation. So you're actually losing on your money. Then looking at savings, which is now building up capital sums through regular contributions, and then mortgages. So let's look at financial protection. What does financial protection mean? It's a life assurance policy to provide a payment on death. Why would you want that? What happens if you've got a mortgage, you've got dependents? You need to make sure that they're provided for. Critical illness, to provide a payment if you're diagnosed with a serious illness. Serious illnesses can be a financial catastrophe to a family, and if you do not have a financial safety net to fall back on, you could again suffer serious financial consequences. Income protection, which would replace your income if you're unable to work due to an illness. We've seen how in last year how many people have had to stop working simply because they're ill and suffered an income loss as a result of that. Unemployment cover, people have lost their jobs, and I can see that this year more people are going to lose their jobs once the furlough scheme is pulled back, and companies have now decided that really and truly they don't want workers, or they can work with maybe half the workforce. And personal accident cover would simply pay out a cash sum if you were to suffer an accidental injury. And then there's private medical insurance, which means that if you needed private medical treatment, it would be paid for. So what is the need for financial protection? Let's look at some of the statistics. Last year, 608,000 people died in the UK. Of that 608,000, 82,000 were COVID related. So you still got, over 10,000 people a week who are dying. And these are deaths of breadwinners, but death of a person who is supporting a family. Almost 1,000 people are diagnosed with cancer every day, and 50% survive at least 10 years. They say that amongst the baby boomers, 2 in 3 people will be diagnosed with cancer, and everybody knows somebody who's suffered, who's been diagnosed with cancer. Every 5 minutes, someone in the UK would be admitted to hospital suffering a heart attack. 1.4 million people are estimated to be living with the after effects of a heart attack. People living with multiple sclerosis, 100,000 people will have a stroke. Again, how long does it take to recover from a stroke? These are all things that can cause serious financial impacts within the family. The average household is just 24 days away from the breadline, meaning that if somebody were to lose their job or were unable to work, they would, within 24 days, they are, at the food bank. Illness, loss of income, how financially resilient are we? 9 in 10 people don't see themselves, that is their earning potential, as being their largest financial asset. And even though their lifetime's earnings is significantly more than a property, car, or savings pot, if you look at what you're going to earn over your lifetime, that is the biggest amount of money that you would have. But we insure our cars, we insure even our mobile phones, and yet we don't consider insurance for ourselves being too important. So let's look at retirement planning, which is the next stage of financial advice. And what is retirement planning all about? It's simply building a fund to provide an income when you stop working or when you want to stop working. What do you have available if you stop working? You've got the basic state pension, which everyone's entitled to if you've paid your share of national insurance contributions. There are company pension schemes. A lot of people are members of company pension schemes. You can have income from investments. People might say, okay, what I'll do, rather than have a pension, I'll invest in stocks and shares, or I'll invest in property, so income from property. But retirement is evolving. People are continuing to work after retirement age. And because when pensions first started, over 100 years ago, a lot of people were manual workers, and at age 65, they were totally exhausted. Today, you've got people working in jobs that they like. So you take people, for instance, in the creative arts industry, they might work, throughout their life. But what might happen is that they want to slow down, and therefore retirement planning is still relevant to them. And some just want to hang up their boots and do nothing but enjoy the later years of their life. All right, I've worked all my life, that's it. Get to 65 and I'll call it a day. So the need for retirement planning, if you don't plan for retirement, then obviously you're not going to have any income, or very little income when you stop working. You may have to rely on the basic state pension only, which is £175 a week currently, so not a lot of money there. And that's provided you've made 30 years of full NI contributions. You might rely on other investments or property to provide, but they might not provide the desired outcome. They also don't benefit from the tax advantages that a pension plan has. You might have to continue working, but not out of choice. There could be a drop in the quality of your life if you don't have an income in retirement. Health problems in older age could become more pronounced if they're financial worries. I mean, if you've got certain illnesses and you're in old age, and then you've also got financial worries, you're certainly not going to be feeling too well. Commitments that are due for payment could wipe out any cash savings. People say, okay, I've got properties, I've got these buy-to-lets. A lot of buy-to-lets are on interest-only mortgages, and these mortgages have actually been set up to be redeemed when they retire. But if they don't have the cash, then they're going to sell the property. So this property portfolio that they've built up might not be there to provide them with a retirement income, and therefore a retirement plan becomes useful. So what are the benefits of setting up a retirement plan? Why is this such an advantage? And the big thing about a pension plan or a retirement plan is the tax relief on contributions and the fact that the investments grow free of tax. Now, this is a great thing, because if you've got an investment, say you've got a property investment, and you sell that property, you're liable to capital gains tax on that property. Money in a pension would not be taxed. So you've got a great tax advantage, and of course the money going in, it gets tax relief on it. So you can contribute up to 40,000 to retirement plans each year and receive tax relief. Again, there's a limit. So although we say 40,000, it's limited by your earnings. So if you're earning, say, £20,000 a year, the maximum you'd be able to contribute would be £20,000 a year. If you've got, for instance, a limited company, your company could pay in 40,000 to your plan. There's a lifetime allowance of just over £1 million, and that's the amount that that savings, that your pension and savings should not just give. Oh, sorry. Oops. 1 minute. Sorry. So there's a lifetime allowance of over £1 million, just over £1 million, which means that the total value of all your pensions can't exceed £1 million, or it would be taxed. There are other limits for higher earners. If your earnings are over £240,000, then there's other limits as to what you can put into your pension. Currently, you can take your pension benefits at age 55. And the other benefit about setting up a retirement plan is you're taking positive action to provide for your retirement. There are a range of pension options. There's personal pensions, SIPs, self-invested personal pensions, and SSAS, and small self-administered schemes. So there are a variety of options for you to invest into pensions. Investment and savings. Short-term, medium-term, long-term. So you can invest over the short-term, medium-term, or long-term. Tax-efficient savings. There are a number of tax-efficient savings that you can put your money into. Deposit accounts, bank deposit, national savings and investments. Lifetime ISA. This is an excellent product that you can use now, where the government, and I'll come on to that later when I talk about mortgages. Stocks and shares, asset-backed investments, pooled investments. I mean, one of the problems that people have with buying stocks and shares is that, okay, because of the amounts of money they've got, they're limited as to how many stocks and shares they can, how many shares they can actually buy. And the best way to hedge against the volatility of the market is to be able to invest in a wide range of shares. And you can do this by having pooled investments. Now, with bank interest rates at best 0.5%, stocks and shares, asset-backed investments are the only way to really get a return on your money that's going to be a hedge against inflation. One of the things that you do have to consider with investments is your attitude to risk. If you're a person who doesn't want to take too much risk, then there are certain investments that you wouldn't go into. And if you're a person who is quite happy to take quite a high level of risk, there are investments that you can go into which would have a potential of a greater return, but again, a higher risk. And one of the things that we would do with any financial planning service is to first of all look at your attitude to risk before making any recommendation. We'd also look at things like your capacity for loss. In other words, with any asset-backed investment, there is that element of risk that your investments could lose their value, and what level of loss are you able to take without it affecting your lifestyle? So that's one thing that we'd need to. The options of investment funds, again, you can invest into funds that will invest in certain shares that come that are in particular sectors. You can have your investment into funds that are ethical, or they reflect a particular geographical location or a particular industry. Again, a wide variety of funds for you to choose from. I mean, there's lump sum investing, where you take a capital sum and invest it to grow over a period of time. And then there's regular savings, building up that capital sum. When investing, you're looking at the options. Are you investing for growth, or are you investing for income? Again, with any financial planning service, all these things would need to be reviewed with you to find out exactly what you want with your investment, and before recommending any investment to you. So let's look at mortgages. And with mortgages, you've got different categories. You've got the first-time buyers, you've got the home movers, the people who are selling up and moving, or keeping their property and moving. You've got remortgaging, where you've already got a mortgage. Have you reviewed it recently? Are you getting the best rates are particularly low now? Further advances, in other words, taking an additional loan on your current mortgage. Second charge mortgages, again, you want to borrow money on your property, but you're stuck in what's known as a fixed rate with a particular mortgage, which means that if you were to remortgage or come out of it, you'd have to pay a redemption penalty. You could look at a second charge mortgage, and then you've got the buy-to-let mortgages, which are essentially for investment purchases. The loan to value with residential purchases, you can usually borrow up to 90% of the purchase price or the valuation. But you will get better prospects with a deposit of at least, say, 15%. The lower loan to values offer much more competitive rates. With buy-to-let properties, investment properties, LTVs are usually about 75%. I mean, there are companies that will lend you up to 80%, 85%, but then again, this depends on rental assessments. Income multiples, affordability play a lot with determining how much you can borrow. Companies tend to look at an income multiple of, in the region sometimes, of about 4.5 to, at the top end, 5.5 times your income. There are schemes for first-time buyers, the help to buy equity loan, where the government will lend you money based upon taking a share of the property that you're purchasing. This has just been, there's a new help to buy scheme that's just recently started, and now it's open only to first-time buyers, not to home movers. There's the right to buy scheme if you wanted to buy, if you've got a council, if you're a council tenant, you can usually purchase a property at a discount. And then there's shared ownership where you're able to buy a portion of the property and rent the other bit, rent the other part, sorry. Yeah. Now, one of the ways of getting the funds or the deposit to purchase, particularly for first-time buyers, is using the lifetime ISA, which where you can save up to £4,000 a year, and the government will actually give you a bonus of 25% each year. So each year you've got another £1,000, which is pretty good because it's an interest of it's like getting an interest of 25% on your money. You can't beat that. There are certain restrictions. You must be between the ages of 18 and 40 to be able to open one of these lifetime ISAs. Currently, there's a stamp duty holiday. Just one thing on the help to buy. It's been mooted that they might be introducing the mortgage guarantee. So watch out for what Rishi Sunak says in the budget this week. Stamp duty holiday. Currently, there's no stamp duty on the first £500,000 of the purchase price, and this is ending on the 31st of March. Again, they say they might extend that. There's no. I'm not seeing a lot of positive talk around that now. So anybody who's in the process of purchasing property, if you can complete before the end of next month, you'll save yourself a considerable amount of money. With first-time buyers, there is no stamp duty on the first £300,000 of purchase. This looks like it will continue after the current stamp duty holiday with the 500k, so it doesn't seem that government is going to tinker with that. Getting a mortgage, what does it? What do you require to get a mortgage? How do you prepare yourself for getting a mortgage? I think one of the things you should do is do a lot of what Soraya said you should do. That will put you, on very good footing. You need to have a deposit of at least 10%. You can, with a deposit of 5%, use one of the help to buy schemes. Yeah, but then currently that's limited to just new build properties, which tend to be quite expensive. So I would say you need a minimum of 10%. Let's see what happens with the new with the announcement this week by Rishi Sunak. Existing financial commitments will be taken into account: credit cards, loans, dependents. This is very important. If you want to apply for a mortgage, they will look at your current liabilities, the loans you've got, the credit cards. And there's one thing about credit cards. Credit cards will, if you have a lot of debt on credit cards, it tends to give you a lower credit score than if you had a lot of that money on loans. And the reason why is because credit cards are revolving credit. So even if you clear them with your credit cards, you can still go back the next month and spend on them again. Applications are credit scored and are assessed on affordability. Late payments, and I'm seeing this a lot now, even a month's late payments, they're declining applications. Defaults on credit agreements, lenders don't like that. CCJs, bankruptcies, there will be decline. You need a good credit profile, and it pays to check your credit file, Experian, Equifax on a regular basis, just to make sure that you're on top of things. cut down on credit cards. Use debt stacking would be an excellent way. And once you've paid off a credit card, close it down so that it doesn't appear on your file as available credit. Cut down on credit cards and other financial commitments. Don't withdraw cash on your credit card. Not a good thing at all. Lenders think if you're resorting to using your credit card for cash, things can't be too good. It's an indication that you're living way above your means. Stay away from payday loans. Again, they don't like these things at all. Other considerations, what other things should you consider in your financial planning? Wills, 75% of 35 to 54-year-olds don't have a will. 50% of couples don't have a will. If anything, if a death occurs, you've got the problems with dealing with the estate. Putting life assurance in trust. A lot of people carry life assurance that they don't put in trust, which means that if anything were to happen, that money forms part of their estate and goes into their estate, and therefore either swells the estate, or the beneficiaries can't get their hands on that money because it might be used to settle outstanding liabilities to the estate. Nomination of beneficiaries on policies, pension schemes, again, very important. And then inheritance tax planning, and particularly for people in the Southeast, where property values are quite considerable. Currently, with the residential nil rate band, etc., there's an inheritance tax allowance between individual of £500,000 and between couples about £1 million. But you know, properties in London would take your estate way above that, and it means that an inheritance tax bill is potentially there. So again, it's another thing that one needs to look at. Right, thank you for listening. I've got my details here, and we'll be quite happy to answer any questions.
Thank you very awesome. Thank you very much, Mr. Deji. That was wow. As I said, I'm feeling equipped and even more and more equipped as we been exposed to considerable amount of information that I trust that we're all blessed and beginning to consider how we make financial decision, think about the financial journey we're on. Thank you so much. I will leave it open to the floor now in terms of questions and answers. We've all heard the presentation, hopefully have time to digest it a bit more. But if you have questions, it may be in other areas that we haven't covered today, but you have questions around it, please feel free to even raise that. I know there's one that I would like to ask, but if you have questions where we haven't spoken about that particular topic, but it's burning, or you want more information, please, this is your opportunity to do so. So I'll leave the floor open. If anybody would like to ask a question, you can either use the put your hands up, or you can unmute yourself, or you can put it in the chat. So there's several ways of doing that. Or you can just, you can send it to me directly as well. That's also fine. So I believe Bola.
Yes. I have a question, please, about life assurance. I mean, you talk about, I know sometimes they said it's for some, you know, for some years, maybe till 70. Which one is better, till death or till a specific time?
Right. A life assurance policy ideally should be set up to cover a certain thing. So, for instance, if you've set up the life assurance to cover dependent children, then ideally it should be for that period whilst they're dependent on you. If it's to cover a mortgage, then it should be for the term of the mortgage. However, you might want to consider whole of life assurance to pay for things like funeral expenses and inheritance tax. So again, it depends very much on, you really need to sit down and decide what it is you're actually trying to cover. What is the particular thing you're trying to protect?
Okay. And so you might have different life assurances then. Maybe one
yes,
for income, one for.
You could have several policies. Yeah, covering different different situations and providing protection for different events that might happen.
Okay. But is it what should I say? Is it wise, to have so many different ones? Is it?
Well, what you should.
Financial prudence? That's what I want to say.
What you should have is the insurance that you need, and the first important thing is to find out how much insurance do you need. So one would look at things like how much is your mortgage, how old are your children, how long are they going to be dependent on you, is your spouse working or not working, is your spouse dependent on you, do you have any other liabilities that need to be covered? So you need to look at all that, do the maths, and then say, right, this is the amount of insurance you need for either X number of years or throughout life. So it depends on what your insurance needs are. So you need to have a review of your insurance and assessment that would indicate how much, or rather tell how much insurance you need. So there's no point in just buying an insurance policy for the sake of saying, okay, I'll buy a £250,000 policy. You may or may not need 250,000. So what you need to do is to assess how much insurance you need.
How much?
And what type of and what type you need.
Okay, thank you.
Okay, thank you. That's great. More questions or comments, observation, thoughts?
I have a question, if that's okay.
Yes, please. Do go ahead. Thank you. I believe that's Ronnie. Yes, please.
Yes. Yes, girl. Good evening, everyone. Thank you so much for an insightful session. Very, very inspiring. Thank you. I do have a question regarding the cash ISA you mentioned, Mr. Deji, with respect to the age-wise. You said,
oh,
so
yes,
you can actually open a cash ISA for a 14-year-old or up to 18-year-old, and you can actually increase the money on a yearly basis, about 4,000.
Yes, that's for a junior ISA. The ISA I was referring to as a lifetime ISA, which is a specific ISA that was set up by the government to help people purchasing property. So yeah, but on a junior ISA, yes, you can, as long as it has to be a cash ISA if it's a junior ISA.
Okay, and then as a parent, you can actually invest into the children's ISA?
On their behalf, yes. So you can put up to £4,000 into their ISA for them.
Oh, fantastic. On a yearly basis?
Yeah, each year. Yeah.
Okay.
Into the children's cash ISA, yeah.
Does it have to be cash only? Can you do like
not until they get to 18.
Okay.
Yeah, up until 18, it has to be the junior ISA is a cash ISA.
Okay. One more question. Retirement account. Any insight into that, and what's the best option for that?
When you say a retirement account, are you referring to a pension plan?
So to speak, yes.
Yeah. So what's the specific question you've got?
Because I was told one can have a retirement account where you can put a certain amount on a monthly basis, and then it's tax efficient. And
oh yes,
it just helps to build towards the pension as well. So in terms of that,
yeah,
in conjunction with the pension plan and the retirement account as well, is it something good to have, or is it just better to focus on the pension plan?
A retirement account is a pension plan by another name.
Ah, okay.
So what you might find with the retirement account is that it's on what is known as a platform, which is so it's got the tax wrapper of a retirement account, but it still has the same features of a pension plan. The only thing is it's got probably access to more funds and has a wider range of investments that you can invest into. But the feature, so you can contribute to both the pension plan and the retirement. It depends on things like charges, which, what's the charging structure like? If you've got a pension plan, if it's a company pension plan and your employers are matching contributions, then you might want to put money into your employer's pension plan to benefit from matching contributions. So again, it depends very much on what the situation is before you can decide as to which is the better option.
Oh, fantastic. Thank you.
May I just thank you so much for that. Thank you, Ronnie. Thank you, Mr. Ogudeji. I think just to add on to that, I have a question and perhaps a comment as well. So with the retirement plans, for someone who may have a deficit, so perhaps they haven't contributed at all in their pension plan, the private one, would it be fair to say then they can use a SIP or an ISA to do so? So you can set up your own, if you like, retirement plan or retirement income, where you're paying a certain amount of money monthly, which will be covered because it's tax efficient. It's for your retirement purposes.
Yes, you can do that. SIPs were very, very, very popular a number of years ago when everybody wanted to do their own investments, and during the Gordon Brown. When Gordon Brown was Chancellor, I think he was even Prime Minister once, wasn't he? Yeah, Chancellor anyway. He'd come up with this idea that you'd be able to put buy-to-let property into a pension. And what happened was that a lot of people jumped into SIPs thinking that they could now put their BTL portfolio into the SIP. It never happened. So with a SIP, there's certain things you can put into it. One of the things that you can put into it is commercial property. You can choose the investments you want to put into it. So people like to go down that route because they want to make their own investment decision. But I would say for the majority of people, a straightforward pension plan, retirement account would be probably the most suitable, because they wouldn't be exposed to the charges that you would get if you're running a SIP, because you've got to have a company that would administer. But you could have a SIP, you could have a pension plan, and you could also have an ISA, and you could use the allowances. And ISA allowance is £20,000 for this tax year. So yeah, you could use them. Yeah.
Okay, brilliant. Thank you.
Can I ask a question? A really, really exceptional session. I don't know whether you are a Christian or your faith, but and that's irrelevant. The only reason I say that is not that it's irrelevant, it's not important, but what I'm just trying to say is I prayed this morning and my prayer was, Father, I need take the limits off of me financially. Yeah. And give me some ideas, show me practical ways where I can tap into unlimited resource. So for me personally, you've been an answer to prayer. Today. Thank you for what you have done.
Thank you.
And I will be reaching out to you as well. So please expect my call. And secondly, if I want a mortgage and I'm 52, so I don't have much time, is it better for me to go for, and it will be a second mortgage, is it better to go for, to make sure I build up a deposit over 15%, or is it better to go on the property market like the rent schemes where you can put down a smaller deposit of about 15,000 and then start renting it, and within a 5-year period have more money and buy it outright? Which would be better?
Second mortgage.
Oh, I had a mortgage years ago, but I don't have any more, and I haven't had for about 15 years. So
okay.
Buyer is what I'm saying.
Okay, so you're looking at the shared ownership option.
Yes, is it better to go for that, or?
It's an option. It's not. Look, there's no such thing as a bad scheme. It depends on what's most suitable to you, right? The only problem I have with the shared ownership schemes is when you want to move on, if you haven't staircased and bought 100% of the shares, you could be delayed in trying to sell that because you can't sell it on the open market. You've got to sell it back to the housing association. So that is the problem. So shared ownership is great if it's going to be a long-term thing. if it's to move on to something else, it's a bit of a difficult thing. And I would say look at one of the government schemes like the Help to Buy scheme, and also this new scheme that's coming out this week, the mortgage guarantee scheme, and they might offer you more flexible options. But if those don't work, then the shared ownership is not a bad. Everything boils down to deposit. The larger deposit you've got, the more flexibility you'll have in terms of your mortgage choices.
Okay, thank you. Thank you very much.
Thank you. Thank you, Shireen. Thank you, Mr. David.
I have a quick question, if that's okay.
Yes, yes, please.
Sorry, I'm not able to show my face.
No, that's
really, really insightful evening. I've learned tons. I had a question with regards to the critical illness, serious illness that you mentioned. I think you said that critical illness was a payment on diagnosis of a serious illness.
Yes.
Does that mean that you have to be seriously ill before you get something, or does that mean it's like, for example, I don't like to call things, so I'm not going to call something, but let's just say something happened and it was the beginning of something, you would get paid out, or I'm not quite sure how that works.
Yeah, with a critical, excuse me, with a critical illness policy, as it says, it's on diagnosis. So God forbid, if a person were diagnosed with cancer, it would pay out, even though that condition doesn't stop them from working. They can still carry on with the fact that they've been diagnosed with it. It would pay out the lump sum. There are a number of the conditions that that the plan would cover, which would be within the policy document. But yes, you know, cancer, heart attack, stroke, biggest payouts are cancer. I mean, so many critical illness plans have paid out because of cancer.
And how many organizations now cover for COVID?
Well, they don't cover for COVID specifically. In other words, there isn't a plan that says if you contract COVID, we'll pay out. But if COVID leads to something else, then they will pay out on that particular condition. Now, let me give you an example. A person had income protection.
But in saying that, all of you need to.
Sorry, and they were unable to work. It would pay out. It wouldn't pay out because they had contracted COVID, but it would pay out if COVID, as a result of COVID, some other condition arose.
Oh, okay.
Yeah.
Okay. And is there a difference between critical illness and serious illness?
There is a slight difference. Some companies will cover what's known as serious illness. So a serious illness could be something like a local cancer, something that's localized. And then you might get what's known as a partial payment, but they're very similar. You know, there's the critical illness and serious illness. They're similar. It's just that with some serious illness plans, they'll pay out a percentage of the sum assured if the illness is considered to be not considered to be critical.
Okay. And my final question on the subject, sorry, because I want to look into this kind of area for myself.
Yeah.
How many conditions are actually covered by the critical illness thing?
Oh, I mean, the companies cover. Their companies will cover up to over 100 different conditions. It depends on the companies. Cover different numbers of conditions, but about on average you can get over 100 conditions covered.
Okay.
With most companies.
Cool.
The main ones: cancer, heart attack, stroke, organ failure, seem to be common amongst all the companies, and then some companies will go a little bit further. But yeah, over 100 conditions with most companies.
Okay. Thank you so much. Thank you so much.
Thank
Been
you.
really good. Thank you.
Thank you. Thank you for raising the question, and thank you, Mr. Deji.
You're most welcome.
Floor still open. We have 15 minutes more to go. If anyone has questions or comments or observations, please feel free. I know I've got one, whilst perhaps people are thinking of it. And going back to retirement. Now, for those people who are fast approaching retirement, or perhaps another 10 years to go, and you work for various companies where you've left behind your, pension pots, as it were, what should we start looking to do? I mean, some of us don't even know where those, how do we access it? You've moved to several places, you're not even getting information about what's in your pension. What do you do? How do you deal with that? Because that's
this is a common thing.
Doing what you have, yes.
Yeah, this is a common thing, and it's very, very important to know what pensions you have got, because the worst thing would be to live through retirement and only to find 20 years into retirement that you had some pension pot of 100 and something thousand pounds that you didn't touch. Yeah, I would say the first thing to do is to write to, if you don't have, normally they should send you recent statements. Even if you've left a company, the scheme has become, you've become a paid up member of the scheme, they normally will send you an annual statement. Sometimes you've actually moved addresses and haven't informed them, so that's another thing. So they don't even know where people are. Write to the human resources department of the companies that you worked for, or call them up, and then get that information from them. The first bit of it, they might direct you to the trustees of the scheme, and then you can phone up or write to the trustees and start to get that information, update your change of address, etc. And then ask them for a statement of your current pension. And they will send you a statement telling you how much is in the scheme, how much you're going to get when you do retire. And one of the things you can do, if you've got several pensions from several organizations, you can actually consolidate all those pensions and put them into one pot. So you've got, let's say you've got a pension with BT, you've got a pension with Barclays, you could put all those pensions together. Now, one thing I should warn you of, if they're final salary schemes, it might not be so easy to consolidate them. And the reason why is that you'd have to make sure you're not losing out on any safeguarded benefits, things like guaranteed pensions, etc. So again, first of all, get the information, have a review, and then you can be advised as to whether to consolidate them, and those that you don't consolidate, you continue to benefit from the investments, continue to benefit from where they're invested, and when you do retire, whatever the age is. But first of all is to get the information.
Awesome, thank you very much. And any more questions or thoughts, observations?
Yeah, I think I will also ask more questions. I mean, to expand on the question that you've asked. I mean, you've talked about working in various places. I wanted to know, working with agencies, I don't know whether ones also, pension contribution, I've never even. Do you know whether agencies?
Oh, I mean, well, it depends again. I mean, you'd have to find out from them, because again, under auto enrollment, if on PAYE, they should have been making pension contributions on your behalf. The one thing you can do is look at your pay slips, and you will see on your pay slip if there has been a pension contribution, be it an employer or employee contribution. So if it's on your pay slip, that's an indication that you do have some pension entitlement there.
That's great.
Thank you.
Lovely. Thank you. Thank you.
And then I wanted to just to another thing. If one has a private pension that is set up privately, I mean, is it a good idea to set up another, I mean, maybe a private pension just to?
Yes, it's a good idea. Again, depending on whether you're employed or self-employed. If you're employed and your employer has a pension, a company pension scheme, you might be better off making contributions to their scheme because they will match your contributions. So for instance, if you put in 5%, they might say, we will also put in 5%. So you've got a 10% contribution. But if you do it privately, then you'll only get your contribution. So you need to look at whether your employer offers a scheme. If you're self-employed or your employer doesn't offer a scheme, then yes, setting up a private pension is a very good idea.
Okay, that's very, well, that's a good, what shall I say?
That's brilliant.
I have one question. Well, it's just
please.
Yeah, I need help with my retirement planning. Mr. Deji, are you the best person, or I won't say you're the best person. Are you, I don't know what services you cover. So I would like to use your services for my retirement.
Right. Okay. Yeah. Would you prefer to call me and so that I can discuss it with you?
Okay. I'll take your number from any.
Yeah. So if you give me a call, then you know, and then if I know exactly, I mean, you might not want to discuss exactly what you want to do, then and you tell me what you want to do, then I can let you know whether it's something that we can.
Yeah, and if you are not in a position to help, then maybe you can point me to the right.
I can refer you on to whoever, depending on what it is that you actually want to do.
Okay, thank you.
Brilliant, thank you, Auntie Yetunde. Thank you. Any more questions? Any questions? Please feel free. Comments, observation, questions. We have another 15 minutes or so to go, and I have some questions that I believe from discussions with some of you, discussions with other people outside of church as well. And I know property, I mean, if I may take the opportunity while perhaps people are thinking of questions to ask or comments.
He looks to his right when he does the intercept.
Hello? Just okay, no, that's fine. I thought something came on, but that's okay. I thought someone wanted to ask a question. But okay. I think everyone, and Soraya, please also had your wisdom to this as well, as Mr. Deji also shares with us his insights and wisdom. And this is about property. And we know for many people, it's desirable to have a property and to get on the property ladder. But London is so expensive. I mean, we know that it's overpriced for several reasons. What are your thoughts about someone, a first-time buyer, thinking of, well, how can I get on this property ladder? I don't earn much income. I do earn, but I know realistically it'll be very difficult in London. What are your thoughts about the options of going outside of London, exploring places where property is perhaps more accessible?
Yeah. Okay, if I may come in there, this is happening. We're beginning to see people who were in London and are now moving outside of London. And remember, with COVID, the one thing that's happened is more. So what we're seeing is people are buying, looking at properties now, particularly properties that will have like an office within a workspace. So people are beginning to look at that kind of design and property. Yes, I think more and more people will begin to move away from London in order to buy cheaper property. And then what's going to happen, of course, is that that's going to reflect in property prices when I'll start moving up there. You know, but yes, it is an option to do that. A lot of it, even with this government new scheme, because the government is coming up with a scheme that's been much advertised about this 5% deposit and the mortgage guarantee scheme. It's all great, but the one thing they're forgetting is that lenders assess on income. So even if the government says, okay, we're going to allow you to borrow up to 95%, if your income doesn't stretch to that 95%, even though you've got the 5% deposit, you still won't get the mortgage. So it's, and properties in London are over 10 times average income. And multiples by lenders are about 4.5 times income. So, moving out of London, yes, is an option.
Yeah, no, thank you. Yeah, I
Can I
appreciate
just
that.
add in there, thanks,
Yeah,
Mr. Deji, that it really depends on, I think what you just said is based on a residential.
Yes,
but obviously, there are some people that are looking at buying a second property.
Yeah.
That you think about London. I mean, I was one of those that always used to think, oh, I'd like a second property. I'd like all my property portfolio in London. And I just had this London thing in my head. And for some of you that are thinking of, building a property portfolio or second property, think about the cash flow. If you're looking at London, you're not really going to get the cash flow. If you're looking outside of London, then you're going to get a better return on your money. With regards to what Mr. Deji just said in terms of moving out of London, absolutely. I've got, business partners of mine that, they're being offered 20, flats in Chelsea, for a rental income of 20,000 a month. And that's because nobody is, everybody is now working from home. So whereas before, a lot of people wanted to live in London because it would be walking distance or a couple of tube stops or a bus journey to work. Now most people are working from home. So the central London isn't now as desirable as it was before. So yeah, a lot more people are looking at moving out. And just to give you, you're thinking, well, how did Soy come in with this? Also, one of my backgrounds is asset management. So I was in asset management for 15 years and have some experience in terms of asset management. So on that side of things, I can comment on.
Yeah,
great. Yeah.
Thank you. And to both of you, just one thing that I'm burning to say also, and you talked about moving, and I know that there are some people who feel, no, I can't move out of London because, it could be for children, work, church, different reasons like that. Would you then say it's worth considering doing a buy-to-let in London? So your first property could be outside London. It could be somewhere in Manchester, Newcastle. And I'm speaking from personal experience here, that our first property, we wanted to live in London, church is in London, work is in London, everything was in London. But at that time, we couldn't afford to buy a house in London. So we decided to buy outside London, but we didn't live there. So what we did was to rent in London. And then we have a mortgage outside London to a property we're letting out. So you're building capital. Hope of bringing that capital in eventually to use to buy a property, over time as your income appreciates and the capital appreciates, rather than you're letting in London, but there's no capital, your money isn't working for you. I don't know what your thoughts are. Is that still a strategy you would recommend to people, or not recommend? I don't want to use the word, but we will give information on as worth considering.
Yes, I mean, there are mortgages available for first-time buyers, first-time landlords. A small number of companies will offer them, because generally to buy an investment property, the requirements from a lot of the lenders is that you must first of all be the owner of your own residential property or have owned a property before. So it makes it a lot more difficult for a first-time buyer to purchase a buy-to-let property. And of course, the implications of buying a residential property and letting it out, you can have problems with the lender. So, but there are options. Now, there is another option as well, and that's what's known as the joint borrower sole proprietor mortgage. So take, for instance, if you've got an individual, they haven't got the income to get the mortgage they want. They can bring someone on board, a close relative, a parent, a brother or sister, and use their income for the mortgage purposes, but they will own the property. So the person they bring on board is not an owner of the property they're buying, so they're just coming on for the affordability purpose. So that is an option which people are using.
Brilliant, brilliant. Thank you so much. It's just yeah, we're just making information available for people to think about different options available, even if you are on low income and your desire is to get on the property ladder. So thank you so much for both sharing your experiences there and what would be possible potential options for people. So I'll just go back to the ladies. Do we have questions we'd like to raise? Comments, observations?
Yes, I want to ask this question. This is for Miss Johnson. Sorry. Yeah, I mean, I have a property, but I'm not living there because obviously it's not a nice area. So I wanted to sell it. So I'm renting it out, but I need to sell it so that I can buy my own, where a place where I can live. Now, do I have to pay like all these stamp duties and things like that because I'm renting it out or whatever?
Yeah, I mean, that's more of a question for Mr. Deji. But yeah, you would have to, you wouldn't pay stamp duty for selling, you pay stamp duty to buy property. And as you said, rightly so, that the government have got an offer on at the moment that if you purchase before the end of March, they've waived that for any properties under the 500,000 bracket.
But you can't find that in London. I don't know who is going to find any property below 500,000. It's so expensive.
There are actually properties less than 500,000 in the southeast of London, and lots of people are whipping those up. You just have to think about it. Some people prefer to live in North London, South London. For those of you that are born and raised in London, I know for myself, you know, if you're a South Londoner, you do not cross the border to North London. It's like taboo. You know, you're South London, you live in South London, you stay in South London. It's like, do not cross the border. Shireen is laughing. You know, so it really depends. For some of you that came over to the UK as adults, you're like, well, what's the difference? It's just London. And so it really depends. It really depends on your strategy. What I will say to some of you is that myself, I offer a free financial game plan, and that free financial game plan will show you, you know, if it's worth you, what your goal is. So do you want to, the end goal, is it for retirement? Is it long-term goal? Is it for legacy? You know, and what your property is doing for you right now, is it feeding you? Is it serving you? What is it going to do for you in 10 years time, 15 years time, 20 years time? What's the ultimate goal? And that financial game plan will show you whether, you know, you need to tweak to sell, you know, what to, and where you want to go. So that's also something else that's on offer. Sorry, I didn't mention that before, but.
Thank you.
And the one thing you've got to remember with selling your property, of course, if you've let it out, is a potential capital gains tax that you might have to pay on it. Yeah. And another thing is for people who are buying property, rental properties, to consider going down the limited company route. If you're purchasing property for investment purposes, and any properties that are under 500,000, you could actually, if they're owned solely by you, you could actually move them into a limited company, and you would pay an additional 3%, but it's still cheaper than would happen after March the 31st. So if you particularly wanted to move your buy-to-let property into a limited company.
Wow, that's great.
Well, excuse me, can I just ask? But I know that, can you like, I mean, if you want to avoid those capital gain tax, how can you avoid it?
I don't think. I mean, you could. How, if it's owned solely by you, you're not going to be able. You'll have to pay the capital gains tax. Yeah. I mean, if there's a gain, again, only if there's a gain.
Okay, well, thank you very much. I have one question here in the chat. Thank you, Sister Bola, and thank you, Soraya and Mr. Deji. I've just got a question in the chat. So if you are a first-time buyer, can you buy through a limited company? And how can you make the money work for you as an income? So if you are a first-time buyer, can you buy through a limited company? And how can you make the money work?
If you're buying an investment property, yeah, you could set up a limited company to purchase the property. You could do that, yeah. But if you're buying a residential property for yourself, well, I mean, you wouldn't buy it through a limited company. There wouldn't be any point. Yeah.
Fantastic.
But, yeah.
Any, I have a question, please.
Yes, please. Yes.
All right, thanks. Thank you very much, Soraya and Mr. Deji. I just wanted to find out from Mr. Deji, going back to what you said earlier about a credit card. I've always thought that the more money you borrow on credit cards, it helps and you pay back, you know, you're diligent with your payment, that it helps with your credit rating. But one thing you said about, I wanted to find out if you take a credit card and you do a bank transfer into your current account, cash transfer into your current account to pay back later, maybe 12 months, 18 months time, and you do pay back when you're supposed to pay. Is that what you mean, that doesn't help your credit rating?
Yeah, because it's, look, the thing is, if you're taking, what you're doing is you're taking cash on your credit card, and that to a lender is indicating that you need the credit card for everyday expenses, just to live, and that's not a good indicator. I mean, it doesn't mean that it would decline you automatically, but it would lower your credit score. And particularly now, lenders, because there's a lot of business coming in, so lenders, what simply lenders are doing is they're just picking the best of the bunch, and so I mean, I had just last week I had a case declined, only to have it the declination overturned after I raised an appeal against it, but just on a very, very simple thing. So it's best to stay clear of any cash on credit cards and pay back above the minimum payment that that's the best thing to do. But stay clear of taking cash on a credit card.
Okay, thank you very much.
Lovely. Thank you, Mr. Deji. Do we have any more questions?
Yes,
we're drawing to a close.
I have a question for Mr. Deji again. You talked about limited, like you could put the property in a limited company, isn't it?
Yes.
And the same limited company, can you get your salaries into it? If you're working with agencies and things like that.
Well, it would have to be, if you're going to use it for property, for a buy-to-let property, it would have to be a company set up specifically for that. So you couldn't be, you couldn't pay your agency salaries into it. It has to have a particular, what's known as a SIC code that is specifically for property investment. So you wouldn't be able to combine it with another trading company that you'd have now. Okay. And you couldn't use your trading company for that purpose, as it wouldn't have the right code.
Okay, thank you very much.
Lovely, thank you. Well, thank you, everyone. We want to thank our speakers, Mr. Deji, Soraya, everyone, including myself. We've been truly blessed. You're giving up your time, sharing your expertise with us so that we can be more equipped and we can make smarter financial decisions. And with God's help, we can get the desired financial outcome that we want. So God bless you, and we thank you so much. I'm just going to ask if I don't know whether either of you, if you want to make any comments before we bring it to a close. Okay, all right. Thank you so much for your time. So I'm going to ask Sister Florence Mordy to close us out in prayer. And thank you everyone for your time, just here for us sharing, listening and being empowered. So thank you.
Thank you.
Thank you. Thank you. Thank you to both of you for sharing your knowledge and experience with us today. And for me, it's been really informative. God bless both of you. Let us pray. Father, I thank you for this opportunity to gather here today to hear the presentations on effective financial planning. I recognize we are not all operating under, we're all operating under different financial circumstances. However, regardless of our different situations, I pray we have each taken away some nuggets from today's presentations, questions, and answers. Father, we lay all our financial affairs and concerns about money to your divine care and love. I ask that you remove our worries, anxieties, and fears about our finance and replace them with faith. Lord, as your children, we know our finances belong to you, and we are merely stewards. I pray we will be sensitive to your leading in making financial decisions, and that the Holy Spirit will direct us to seek the right paths. Help us, O Lord, to be good and faithful servants concerning our finances. In the mighty name of Jesus, I pray.
Amen.
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 Thank you.
Amen.
Thank you, everyone.
Thank you.
Thank you, guys.
Thank you very much.
Thank you.
God bless
Very
you.
informative.
Thank you.
Thank
God
you.
bless you and thank you very much.
Thanks. Thank you. Bye.
Bye-bye.
Bye.
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 Thanks.
Bye.
Thank you, Annie. Bye-bye.
Thank you. Thank you, everyone. Thank you. God bless you all.
Thank you. Bye-bye.